Absolutely. Well, thanks, Kathy, and thank you everyone for joining us. Good afternoon. I hope everyone's having a great day today, and appreciate you joining us. Just do some brief introductions, and then talk a little bit about Brayn as a firm. This is really meant to be interactive. So, Kathy, hopefully, I don't know if people can ask questions or drop them in the chat, but if you have questions as we're going, please chime in. I want to make this to be as useful for y'all
Can you
as
see the
possible.
chat, Gareth?
I cannot, unfortunately. I'll
Um,
actually no, I can. I can. I don't see anything
all
in
right.
there now. Yep,
Then
perfect.
people should feel free to put it in the chat, and then you can
Perfect.
stop things as you need to answer.
Awesome. Thanks, Kathy. So let's everyone go to the next slide.
Yep.
So my name is Gareth Young. I'm the engineering manager for Brain Consulting. So I manage the commercial and residential energy efficiency tax incentives. So specifically 179D and 45L, the residential energy efficiency tax incentive. I'm a professional engineer. I'm a civil engineer by vocation, but been in the tax consulting world for a number of years now. I live in Houston, Texas, which is really the center of density for Brain. Both Alyssa and I are both in Houston. I have two kids and a couple of dogs. So that's me.
Awesome. Yeah, good morning, everyone. My name is Alyssa Honette. I'm the director of our business tax services group. So the services that fall under that include the R&D tax credit projects, the 174 capitalization analysis, the employee retention tax credit, our cost segregation work, as well as ITC, or the investment tax service, the investment tax credit. I've been working in this space for the last, I guess, 12 and a half years now. I joined Brayn actually back in March, but worked at a CPA firm, a pretty sizable one, for the 7 years before that. So really great to be working with you guys, talking about this space in particular, because at Brayn we really work with a very large number of architecture firms, engineering firms, of all shapes and sizes. So really hoping that you guys are going to find the content today applicable. And as Gareth said, please don't hesitate to raise any questions in the chat. And, if we need to take anything offline afterwards, we'll make sure you have your contact information.
Awesome. So just a bit about Brayn. I think we hit most of this previously, but we're really three legs of the stool. Building science consulting, which is my leg, which again is the energy efficiency tax incentives, as well as Energy Star and zero energy ready homes and commercial buildings, and the 45Q tax credit, and then as Alyssa mentioned, R&D 174, ERTC, cost seg, and Section 48 ITC over on Alyssa's leg of the stool. And then we also have a tax audit resolution team that works with our clients on defending any of these specialty tax incentives, working with the IRS to uphold any of these, or just resolving IRS issues in general related to any of these incentives. So that's Brayn. So we are this is eligible for CEUs. We are a registered provider. So here's the information on that. I am not going to read this to you, but this information is there for your perusing pleasure. And go to the course description. So we're really going to talk about three main topics here: the R&D tax credit, specifically the 174 amortization issue that I'm sure many of you are aware of and fully dealing with or have dealt with in the past few weeks. We'll talk a little bit about 45L, the residential energy efficient tax credit, as well as the 179D energy efficient commercial building deduction. So we'll talk about how you qualify for all of those things. So three major objectives is just awareness of 174 and the recent developments and how that affects R&D. Qualifications and eligible properties for the 179D and the impact from the IRA that's actually now a little bit over a year old. It's hard to believe, but the changes to that program there. And then talk a little bit about 45L and the changes from the Inflation Reduction Act to 45L. So we're just going to hit on that briefly here. So.
Sounds good. All right, well, we're going to kick things off first by talking about the R&D tax credit. So, big picture, this research and development tax credit has been around for a long time. It was first established back in 1981. And the definition of what R&D is actually very broad. And it applies to a wide range of industries. And I'll kind of walk through the major requirements on the next couple slides, but also really tailored into what makes sense for architecture. It is a federal tax benefit that was made permanent back in 2015. Typically, you're going to see anywhere from a 7 to 10% return in the form of a net dollar for dollar reduction in your federal tax liability from the research spend that you incur. Ultimately, usually you're able to, a lot of clients, if they have a tax liability in the year it's generated, so tax year 2022, you can take advantage of offsetting tax year. But if for some reason you have excess credits, they can be used 1 year as a carryback or carry forward up to 20 years into the future. So a lot of opportunity to utilize those. The credit can be taken regardless of entity type. If you're an S corporation or a partnership, that is filed on the partnership or the S corp return, but the benefit flows through to the individual shareholders or partners. There are a lot of different states that also offer R&D tax credits. Unfortunately, Oregon is not one. I know certainly a lot of folks in your space may also perhaps have offices in California. California, for example, is a really lucrative credit. So always worth it to take a closer look, and it really depends on where folks are physically at when they're engaging in R&D. That's where you figure out, what state that should be attached to. And then, finally, we'll walk through on the next slide a little bit more about basic qualification. When we talk about R&D, we talk about, this 4-part test. So high level, the 4-part test, and these 4 components need to be covered for a project or a research initiative to qualify. So, what is an R&D business component, right? It can be either a product, a process, a technique, formulation, computer software invention. In the software space, it's really going to be in the architecture space, it's really going to be the process by which you develop those custom designs, for this particular client solution, given all the various project parameters and requirements. Okay. And at the out, you need to have a permitted purpose as well. So you need to be improving like functionality, performance, quality, reliability. It's pretty easy when we're talking about architectural designs of buildings and the related systems. The work that you need to be engaging in just has to be technological in nature. So no soft sciences here. We're architecture, engineering. So that's obviously pretty clear cut. You do need to go through a process of experimentation. So different trial and error. For you, it's modeling, calculations, coming up with different alternative solutions and designs to meet that end requirement. And then the very final requirement here is just you need to have some level of uncertainty, and it can exist on any one of 3 levels. Doesn't have to be any, all 3 of them, but ultimately you need to be uncertain of your capability, to meet the project requirements, given parameters, your methodology, or the final or most appropriate design. So can you do it? How are you going to do it? Or what's it going to look like? I mean, that's the kind of uncertainty we'd be talking about. And you would look at this kind of on a level of each, project that you would qualify. There are some exclusions specifically for the R&D credit. And this has a little bit, some of these things that are excluded for the credit, we'll talk later, you still would need to include for purposes of the 174 capitalization. But from a credit standpoint, we talk about, no R&D outside the US, no like soft sciences, efficiency surveys, marketing activities, research after commercial production has started. For the folks in the architectural space, we consider commercial production really at that construction administration phase. So we can really be focusing on your, schematic design, design development, construction documents as the core R&D. And then once you get construction administration, you would really say that's when the R&D has essentially stopped. And then the other thing that's really important to point out here, I mean, of course you have aesthetic goals to what a building is going to look like, but it's really not about aesthetics. Like the R&D effort, the technical uncertainties and process to achieve that aesthetic can still have core R&D. So wanted to specify that. And then the final area is, funded research is something we look at. It doesn't mean that you can't be paid for a work, so do it under contract for a client, but it does matter how you're being compensated. So contractual fee types are important. The ones that are most helpful for us and are going to qualify are going to be your firm fixed fee or lump sum contract. If it's some kind of just full reimbursement, time and materials, even time and materials to a cap, that can definitely be more problematic. So we do spend a lot of time looking at example contracts and understanding that. High level, the expenses that can be captured are primarily these three buckets. For architecture, it's really going to be overwhelmingly driven by wages. So we use the W-2 Box 1 wage amount for the R&D credit. If you're a partnership or 1040 filer on a Schedule C, you can actually claim a portion of SE income for partners that would be engaging in R&D. And then we also want to make sure we're looking at the claim being based on spent on qualifying activities. We really use the time tracking to get into that. Supplies, really not going to be super applicable in your space unless there was some kind of interesting prototype development. Contractors, it can be a little confusing. We're really not talking about the subcontractors you guys are working with. What I typically see is maybe you guys need some outsourcing of like BIM services, and that would be more of like a direct support we might get for contractor costs here. Just something important to highlight on the wage activity, so qualifying research expenses. You can take R&D activities on 3 different levels. So certainly the direct R&D, the direct qualifying research. You can also go 1 level up in supervision and 1 level down in direct support. So just want to make sure we're being holistic. You can certainly be factoring in principals and folks that are, overseeing projects and things along those lines. And then just a couple other things to specify here. I already talked about, the business component is really the process by which you're developing these designs. Talked about the project fee types that are favorable. Every company is going to be different, but I would say typically, there's a pretty high percentage of payroll that tends to qualify for a lot of architecture firms. It's not uncommon to see, anywhere from 25 up to maybe 50% of employee time being captured and qualified. And then you'd be taking associated wages with that. And then finally, as I mentioned before, most architecture firms are going to be tracking their time to projects according to phases and tasks. It is super helpful for us to be able to go through and create those connections. And as I mentioned before, we're really focusing primarily on schematic design development, and at least a good of construction documents phases.
Hey, Alyssa, we've got a question in the chat.
Right.
So Jeremy was asking if their contracts are hourly, can the client qualify for the R&D tax credit?
Well, the client would have to be doing like design work as what, like to have a valid business component. So probably not. I think, in certain instances that might be like if you're kind of with like a general contractor and you've got folks that are in a sub relationship and hourly. I mean, there could be a component there, but generally speaking, no, a client's not going to be able to. Great question, though. Okay, so now shifting gears to talk about Section 174. So this essentially came about as a part of the 2017 Tax Cuts and Jobs Act that was passed with the Trump administration, intended as a revenue raiser to help offset that drop, in the tax, in the C Corp tax rates. And there was really no intention for this to actually come into law. Everyone thought it would be fixed before any of these 2022 tax returns had to be filed. And unfortunately, that's just not happened yet. We're obviously having a lot of disagreements in DC right now. So at this point, the change is that those research expenses that you've generated, so let's focus here on employee wages spent in R&D, traditionally you've been able to fully deduct those in the year incurred and then take that credit of, 7 to 10% in addition as a credit. Now what we're having to do is you still get the credit, but you have to capitalize and amortize those research expenses over, at least a period of 5 years. So it's definitely created some challenges, a lot of hikes in tax rates. Like I said, typically you fully deduct those, and the challenge here, not only are you amortizing these, most of you guys, I'm sure, just focused on domestic activity over a period of 5 years, but there's a half-year convention. So in years 1 and 6, you only deduct 10%, and then you deduct the remaining 20% over the intervening 4 years. Important to note here that generally all Section 41 research expenses are going to be 174 costs. There are a couple exceptions that we'll highlight in a bit. There are also, for 174, some extra costs that only qualify under 174. And I want to be able to walk you through those here. So just giving you a comparison of how, if you're doing an R&D study, you have to gross up some additional costs to get at indirect and overhead for 174. Again, it doesn't increase your credit, it just increases the amount you need to amortize, unfortunately. So the total compensation is something that's brought in, which would include employee benefits, not just the Box 1 W-2. So that certainly has a bit of a delta. You would just replace the percentages and then the wage amounts. For those with contractor costs for the R&D credit, typically you take that at a rate of 65%, but you would have to take an extra 30, like the full 100 for capitalization. There's a much broader definition of software development that could even cover website work. Any kind of foreign employees or contractors need to be pulled in for 174 purposes. Any patents and associated legal fees would be important for 174. And then finally, the indirect costs and overhead, you need to be able to go through and take a percentage of these. So tying it to facility costs. If anyone's kind of familiar with a UNICAP, that's really where you go about it, by taking a certain percentage of rent or lease, utilities, taxes, that kind of stuff, and we really direct that to the percentage documented in the R&D analysis. In terms of, we talked about the areas of concern and some of the challenges. Also want to highlight some opportunities for mitigation and improvement of the situation. So the first one, we talked a little bit about SE income. That's something that we're able to capture for these active partners engaging in R&D for partnerships, for example. SE income is not something that you would capitalize for 174. It's kind of a circular reference. The more you capitalize, the more the comp goes up, the more the credit goes up. So that's actually been a really great way for, companies that are partnerships to be able to not be as severely impacted by the 174 add back. Another area for some companies, really in very, very traditional manufacturing, there could be some cost of goods sold exclusions on some material and production labor. I know not really relevant here. The final area is something that Gareth is really going to talk about more, but 179D is a really great opportunity to help reduce that tax liability through deductions. So really looking at that in tandem is a great strategy for architecture firms. And then, at this point, a 174 fix is expected, but when? We don't know when. We're hoping yesterday, but obviously that hasn't happened. Would love to see it in the first quarter of next year, but we just don't know. And so everyone should be prepared going into it. And even, clients who've never claimed the credit before certainly could still really are engaging in and have this sort of expense and really need to be thinking strategy-wise on how to proceed. We have, as a firm, come up with, 3 different service offerings that we've been working with our clients on, throughout the course of I mean, really the whole year. The first sort of category here is just an overall research and experimentation study. If you haven't done any type of R&D credit in the past, or it's not reliable. And so that's where we jump in, do the full analysis. If you want to claim an R&D credit, that's fine. Some just want to be in a position to capitalize. And so we've done projects on that front. The second category is really probably the most prominent, what we've been doing. So this is a bolt-on study to when we're already performing the R&D analysis, and then just expanding and looking at those additional 174 costs. And then the final, we came up with a pre-audit review where, we work in tandem with the client and the CPA, a little more heavy lifting on their end by giving them guidance on schedules, information to go through. And then we do a series of consulting calls and, calculations and things from there. So just wanted to think big picture, during a tough time. I think it worked out really well. And, we're continuing to look at assessments moving into 2023. So that is the last bit for R&D and 174. So we'll transition over to 179D. I don't know, were there any other comments in the chat, Gareth?
I have not seen any, but if anyone has any, please drop them in there.
Perfect.
Happy to address them.
All right.
Good stuff. So yeah, let's chat a little bit about 179D, which is, as Alyssa mentioned, a fantastic opportunity to mitigate some of the effects from 174. So 179D has been in the tax code since 2005. It is for 2006 was the first year that it was in place. It is a energy efficient commercial building tax deduction. So this is intended to incentivize the design of energy efficient commercial buildings. The way this normally works for a privately held property is that the sum of the building area times $1.80 per square foot can be deducted in the form of accelerated depreciation by the building owner. Through last year, government-owned buildings, and then starting in 2023, and we'll talk about this in a lot more detail, government-owned buildings and nonprofits do not have a tax liability to offset. So they are able to allocate that tax benefit to a member of the design team that was involved in the design of one of three systems. So the building envelope, interior lighting, or HVAC hot water. So if any of those three systems were affected by the design in either new construction, additions, or renovations, you can qualify for 179D. Some examples of that we commonly see, K through 12 and higher ed is probably just on project-wise, probably half the projects we see, simply because of school districts as well as universities really having continuous bond and CIP programs and improvement programs as well, and retrofits. So that is a huge opportunity there. If the tax deduction is allocated, it is subject to statute of limitations restrictions. So that means that you have to, that goes on your tax return, and you can go back to any open tax year, which is typically 3 years back. So again, through the end of 2022, it was $1.88 per square foot of building area that was affected. And you are limited by the cost of property, so the amount of the deduction cannot exceed the value of the improvements. That is rarely an issue. The only times we typically run into that would be control systems upgrades, where there's a lot of square footage that's affected at not a lot of capital cost. So again, this is through the end of last year. Alyssa, you mind going to the next slide? Mm-hmm. Awesome. So to qualify for the allocation for government-owned and now nonprofit buildings, again, you have to have contributed to the technical design of one of those three systems. And so these are, some of the typical players that we see that pursue the qualification and qualify for the allocation. Architects are by far the most common. Always are involved in the building envelope design, and then also as typically the prime contractor have a level of oversight and integration of the remaining systems as well. The other one we see a lot is the MEP. again, with their involvement in the design of the HVAC hot water systems, as well as sometimes the lighting systems, if that's an electrical scope. There are some other opportunities for allocation as well. A GC, particularly on a design build contract, can be eligible for the allocation because of their involvement in the design phase. It is possible in design bid builds that the GC can be an eligible designer, but that is really needs to be vetted to confirm that they were involved in the in design of some sort. On top of that, subcontractors can receive the allocation as well, really through their process of taking the schematic or one-line drawings and taking those and turning those into final construction documents and shop drawings, and that whole process is obviously an element of design of those systems. So those are the players that we typically see. Again, if your stamp's on the specifications, it's a slam dunk. If you're a construction manager, probably not an eligible designer. And then there's really a spectrum from those two extremes that needs to be evaluated on a case-by-case basis. Next slide. Okay, so big changes to 179D from the Inflation Reduction Act. And I've alluded to some of these already, but there's some carrots and there's some sticks. So let's talk about the good stuff first. The maximum amount of the deduction has increased significantly. So prior to 2023, the maximum deduction was $1.80 per square foot that was adjusted for inflation. So that was $1.88 last year. Now the maximum deduction is $5 per square foot of building area. So the other big change is that prior to 2023, you had to be 50% more efficient than a reference ASHRAE 90.1 standard. And if you're over that 50% threshold, you qualified. And if you were not, if you're at 49.9, you did not qualify. So now there's a sliding scale. So starting at 25% more efficient than the ASHRAE standard, you can qualify for it at $2.50 deduction. And then if you hit 50% or higher, you qualify for the maximum deduction of up to $5 per square foot. Also, again, the type of entities that can allocate. So previously it was just government-owned buildings. Now it's really anybody that does not have a tax liability. So tax exempt, any tax exempt entities. So I think private schools, private hospitals, hospital systems, as well as Indian tribal governments and Alaska Native corporations. So really a lot of opportunity there. There's a bit of a stick though as well. That maximum deduction is dependent on the project meeting prevailing wage and apprenticeship requirements. So we'll go through those in a little bit, but if the project does not meet those requirements, that deduction is reduced by 1/5. So it goes from, it's 1/5 the total amount. So from $2.50 to $5 down to 50 cents to $1 per square foot if those requirements are not met. We'll talk about that in some more detail here in a minute. So again, a lot of opportunities out there with the IRA, really with the nonprofits coming into play. So one thing to consider is that buildings, the square footage in a building can only be allocated once. So if you have a school and then you do an addition and that school had already been certified for 179D, only the addition could be certified down the road. As nonprofits were not priorly eligible for 179D in the past, all of that square footage is now up for allocation. So really any addition or renovation to any of these buildings, you have the potential of securing the deduction on the entire building area. One thing I want to mention as well on buildings, on additions and renovations, is we model the entire building, not just the affected area from your scope of work. So there's a good chance we'll be able to qualify the entire building from the improvements that were made on an addition. So a lot of opportunity there. Okay, so this kind of is a quick matrix of whatever the design scope is, the designer of record, and if that's going to be eligible or not. The good news for this audience is that architects typically qualify for every project that you touch. I can't think of any, if not many, examples of that not being the case. I'll also point out, actually, go back one second there. Thank you, also, that you don't need to have contributed to all of these systems to qualify for the total deduction. So if you are an eligible designer on any one of those systems, you can be allocated the full deduction for all systems. So that becomes really important on securing allocations early. A lot of entities have a first come, first serve policy. So would highly encourage you to speak with your owners during the honeymoon phase when everyone's got their signing pens out, when everyone's getting their notices to proceed ready. Secure that allocation, let it sit on the shelf to make sure that you've got that in your hip pocket. It allows your finance team to do tax planning in the future, and it ensures that you secure that full allocation. I didn't mention this earlier, but the deduction is actually taken the year the building is placed in service, and that typically means substantial completion. But there's nothing that ties the timing of the allocation letter to the completion of the building. It's just the actual certification and then the claiming of the deduction. Awesome. So there are a couple of things that need to be on the allocation letter by statute or by notice from the IRS. The cost of the property installed, as I mentioned, the value of the deduction is limited by the value of the improvements, and so that needs to be stated on there just to make sure that we're not exceeding that. Also, the date the building was placed in service, description of the systems that were impacted. It needs to be assigned by an authorized representative on both parties. So that is very important, and that's actually the subject of a previous court case, is ensuring that you don't have groundskeeper Willie signing the allocation letters, that it's someone with signatory authority for the owner. The allocation letter will include any split allocations as well. So the percentage of the allocation that is going to each one of the parties will be listed on the allocation letter. Awesome. So just a brief case study. I'm not going to go through this line by line, but it really does exemplify the impact of the IRA going from $1.80 or $1.88 per square foot, up to $5. So as you can see there, it really is impactful. One thing I do want to mention as well is that previously partial deductions could be had. So if you just did lighting, you could qualify for just a lighting deduction at 60 cents or 61 cents. If you just did a building envelope upgrade, you could qualify for that 60 cents, that 1/3 of that $1.80. That's not the case anymore. Starting in 2023, you can still qualify for those limited scopes of work. However, we still model the entire building, look at the energy efficiency of the entire building, not just that one system. So that is another change from this year. Okay, so prevailing wage requirements. We have had a lot of questions on this. So first of all, the good news. I see some questions here, and I'll pause after the prevailing wages discussion and run through those. So the good news is that none of this applies to any project that started construction prior to January 29th this year. So most of your projects that are getting placed in service into 2023, even into 2024, none of this will apply to. There are two definitions of construction start. One is the physical work test. So did you actually start work on the project, and was the work essentially continuous from the time it started? There are exclusions. Site clearing does not qualify. I think the IRS had enough foresight to understand that contractors or unscrupulous folks may run out with a shovel and scrape some dirt and call that the start of construction. So while site work does qualify, just site clearing does not. The other way you can determine construction start date is the 5% safe harbor. So that means that 5% of the total project cost was incurred prior to January 29th. Construction will have been considered to have been started. So physical work does not include design, permitting, all of those pre-construction activities. The 5% safe harbor does. So you include all of those, all design costs, permitting costs, also any prefab, long lead items, that sort of thing that gets ordered. All of that can be calculated in the 5% safe harbor. So the way you calculate prevailing wage is through it basically follows Davis-Bacon wage requirements, if you're familiar with that. So for each area, for each jurisdiction, and for each labor classification, and this is real just for laborers, for mechanics, folks, they're actually doing the physical work, not supervision or superintendents. You can look up both the wage and the fringe benefits minimums in that jurisdiction, and you just need to document that the project is paying those rates. There is IRS guidance out there, and I'll be happy to share this with anyone that's interested. You do not have to have certified payrolls to verify prevailing wage requirements are met, but you do need to have a list of all of the workers that were working on the project, what they were being paid, and what the prevailing wage was that was in effect at that time in that jurisdiction, and that all needs to be documented. A lot of times on federal projects, there may be local prevailing wage requirements, but you just need to make sure that you're also meeting the Davis-Bacon prevailing wage requirements as well. So I see a couple of questions that popped in the chat. I'm going to pause and go through these. So will the slides used today? Yes, these will be available. I think Kathy will send out a link to these after the fact. Is the allocation letter a template form, or is this generated by our legal counsel? So yes to both. We have Brayn has a standard allocation letter format that we use. A lot of institutions will also have their own form of allocation letter that they require. Actually, all of the state universities, I think of in Oregon State, University of Oregon, have their own allocation letter format that they require. There is not a form that's needed. It just has to include those components that we talked about earlier. And then 179D, would multifamily affordable housing project qualify if the developer is a non-for-profit and subject to prevailing wage? So yes, so the project needs to be 4 stories or higher. So it needs to be a commercial project under commercial code as opposed to a residential code. But if that is met, then yes, the project would be eligible for 179D. The other issue when we run into sometimes is who the building owner is. So we just need to make sure that the owner is actually a non-for-profit, is not an operator or leaseor of the property. And I don't get into too many rabbit holes. It's really who is the taxpayer on that property. So there are opportunities where a leaseor can be the nonprofit and allocate, but that's not terribly common. Thanks, great questions, all of those. So thank you for keeping coming. So moving on from prevailing wage. Okay, so that's it on 179D. We'll talk a little bit about the fraternal twin from 179D, which is 45L. This also changed significantly with the IRA. So we're going to talk about through 2022, and then we'll talk about what's going on now. So it is a $2,000 federal tax credit, so as opposed to a deduction, that is eligible to home builders and developers and manufactured home manufacturers that meet certain energy efficiency standards. It has to be 3 stories or less. It can be single family, affordable multifamily, single family, or manufactured homes. It is actually an IECC comparison that we make as opposed to a ASHRAE standard. So again, going back to the residential energy code, certification is done by a HERS rater, by a third-party HERS rater, and the entity that's eligible for the tax credit has to have basis in the property during construction. So if you're a fee builder, if you're basically functioning as a GC, taking periodic draws during construction, you do not qualify. You need to actually transfer ownership through sale or lease. And it's actually the sale or initial lease that triggers the date for the tax credit. Again, so you take it in the year that the home is originally sold. Okay, so again, big changes with the Inflation Reduction Act. For homes that were sold or leased in 2023 after January 1st, the tax credit has increased from $2,000 to $2,500 for homes that meet Energy Star. So previously we had done a comparison to an IACC standard. Now the benchmark for qualification is Energy Star certification. And for each unit that's Energy Star certified, it's a $2,500 per home tax credit. Also for multifamily homes, that has also been increased to $2,500 for Energy Star, providing that prevailing wages are met. And it's the same prevailing wage requirements that we talked about previously. If prevailing wage is not met, the value of the tax credit decreases to $500. So again, it's a one-fifth, same as it was with 179D. And then again, manufactured home builders are also eligible for a $2,500 per unit tax credit, again, for Energy Star certified units. There's also a second tier that was added to 45L for zero energy ready certified homes. And so basically doubles the value of those tax credits. And we'll go through zero energy ready here in a minute. And I'm sure that many of you in Oregon are familiar with the program as energy efficient as you are there. But it's basically Energy Star on steroids. So Energy Star is the base qualification level, and then it increases and had some additional requirements on top of that. So again, this is basically just a summary of what we chatted about. So the date that the unit was first sold or first leased is the date that you take the credit. Again, prior as single family homes, multifamily units, 3 stories or less, and manufactured homes. Again, you were needed to be 50% or better compared to the 2006 IACC, and that's important. We'll talk about that in just a second. And then $2,000 per unit. And one thing that's important to note here is, like 179D, you're actually able to go back and claim the credit for homes that were built in prior years. So any open tax year, so really 2020 through 2022 would qualify under the old program. With the new program starting this year, again, Energy Star being the benchmark for qualification, the 3-story requirement has been lifted. So because Energy Star has a program for multifamily homes that includes high-rise and mid-rise, if apartments are certified under that program, you qualify at the $500 or $2,500 level per door. So that is a huge change, and we're actually seeing a lot more interest in 45L from multifamily developers, which is really the reason we're having this conversation with a team of architects that don't actually build homes, but is to consider that during the design process. One thing, if you're not, sorry, go back one second. Thank you. If you're not familiar with Energy Star, there are a series of inspections that are required throughout the construction of the home or apartment. And ideally, we do our first inspection during framing, but no later than rough. So prior to the drywall going up or sheetrock going up. If we are not able to get if you're not able to get an Energy Star certified inspector on site to verify the quality of the installation, you cannot qualify that home for Energy Star. So really identifying this early is of paramount importance. I would also say that with the fairly rapid changes, the IRA came out in October of last year, or August of last year rather. It didn't leave developers and designers much time to do an evaluation for Energy Star. So we were really doing a lot of that on the fly over the past 10 months, as a unit was going up. It is very difficult, as I'm sure you all know, to make changes on the fly during construction or after construction started. So if this is something that you or your developers are interested in looking at, I would encourage you to work with your MEP, work with an energy rating company to do an evaluation and see how close you are and what it would take to get to Energy Star. So as I mentioned, with the old 45L, we were comparing to a 2006 energy code. Candidly, that benchmark for qualification was quite low. If you see the relative code stringency with subsequent successive issuances of the IACC, if you were building to code 2018 or 2021 energy code, which I know in Oregon you're doing that and above, you were essentially qualifying just by building a code compliant house. That's no longer the case anymore, but it's just important to know that every home that we've looked at in Oregon has qualified that was started after 2020. Next slide. Okay, so this is basically just a recap of what I said. This case study, I'm not going to read the math to you, but again, with by meeting local energy code, you're going to qualify all of your units. We still need to do the math, but do the energy modeling, but it's pretty much a slam dunk. Okay, so again, the higher standard, the additional requirements for inspections really makes it critically important to at least evaluate the home's qualification for 45L during the design phase. So, really after DDs, once you've started to get some of the details out of the way, getting some fairly easy details in the plan sets, air sealing details in particular, is a big one to make sure that air leakage is not an issue. Is really for the architecture standpoint is probably the most critical. One thing I also want to mention as well, and I failed to mention this earlier, historically there's a requirement that you reduce the basis in your home by the value of the tax credit. So that works. It has a couple of impacts. The first one is, you take a $2,000 per home tax credit. The IRS basically says, hey, congratulations on your $2,000 of additional profit, and they tax you on that. So it doesn't become a net $2,000 credit. It also means, because of the mechanics of the low-income housing tax credit, that we saw very few developers take advantage of both 45L and LIHTC. They tended to favor, because of the basis reduction requirements, they tended to favor the LIHTC tax incentives because it was so much more lucrative. If you are meeting LIHTC requirements, you no longer need to reduce the basis in the development by the value of the credit. So that's a huge opportunity there to double dip on both 45L and the low-income housing tax credit. And again, I'm not going to foot stomp too much on the prevailing wage, but any unit that's placed in service, starting this year, that for the multifamily projects needs to meet prevailing wage to qualify for those higher credit amounts. Next slide. Now I know we're running a little short on time, so I'm going to kind of blow through these next slides pretty quick. Leave some time for questions at the end. Again, not going to read math to you, but basically just a quick case study in really the value in 45L or zero energy ready tax credits back to the project. Where developers are looking at 10% margins and really squeezing for every dollar they can get an additional $2,000 of profit on each one of these projects, especially when you look at mid and high rise multifamily projects. I mean, it can add up to hundreds of thousands, if not millions of dollars on some of these projects pretty quickly. So, and again, going back to what we were talking about earlier on, the impacts of design. Again, depending on the stringency of local code, that jump from base code to Energy Star is normally pretty small. I'm going to briefly talk about just the Energy Star components. I'm not going to go into a ton of detail here, but it really focuses on three systems: the thermal enclosure, heating and cooling, and then water management. And water management that's really making sure it's waterproofing, making sure you have positive drainage away from the building and that you don't have moisture issues, as opposed to low flow fixtures. So big takeaways from the IRA. Again, increasing the value of the tax credit to $2,500 for Energy Star qualified homes and $5,000 for zero energy ready homes. Mid-rise and high-rise projects are now eligible, and up to $2,500 or $5,000 for those as well. And even at $500, if you're not meeting prevailing wage, it is still worth looking at. The LIHTC properties are not impacted by the basis reduction requirements, and the transition to Energy Star is attainable, especially in jurisdictions like Oregon, where base energy code is so stringent. I do want to point out, and there's not a slide on this, but the version of Energy Star that you are held to is based on the project's permit date. So whenever you plan on starting the project, that is the version of Energy Star that you're held to, similar to most building codes. The version of Energy Star that's required by the 45L tax credit that's actually in the legislation is based on when the building is placed in service. So you need to be careful and look at that, look at the timing of those two, and you may need to utilize a more recent version of Energy Star than would otherwise be required, just to ensure that you are meeting the requirements for 45L. So worth looking at. So with that, that's all the slides I had on both 45L and 179D. I did want to touch briefly, and it's not a topic of this, but on the investment tax credit, just to put that on your radar. So this has been around for quite some time, was also hugely impacted by the Inflation Reduction Act. So this is a tax credit that is based on the value of basically on-site generation. So think photovoltaics, geothermal, wind turbines, up to large district heating projects, combined heat power projects, microgrids, microcontrollers. So think of anything that's super green or on-site generation can be eligible for the Section 48 investment tax credit. It's hugely valuable. It can be up to 60% of the value of the energy property back in federal tax credits. It had historically not been eligible. So if you were a nonprofit, you were historically not able to take advantage of that since you didn't have a tax basis, similar to the issue we talked about 179D. There is now a direct pay provision. So if you don't pay taxes, you can actually receive a check from the IRS for the value of the tax credit. So there's a base tax credit, and then there's a number of bonuses that you can qualify for, including domestic content. If you're in an energy community, so if you're in an area that had historically relied on fossil fuels or extractive mining as a large share of the workforce, low-income neighborhoods as well are also qualify for bonus on Section 48. So as you're looking at projects, if you're considering, or if the owner is considering any sort of super green component, please evaluate Section 48 and see what opportunities are there, because it can really move the needle on if those systems and those technologies are viable. And another thing, while there's a direct pay for nonprofits, there's also a provision where if you could take the tax credit, you're able to transfer it. So what we're starting to see is really a marketplace for these tax credits where if you're eligible for a $5 million tax credit in 3 years, you can put it on the market and actually get some cash up front to help with your pro forma, which is a huge benefit. The other thing to keep in mind, and I'll stop rambling after this, I promise. The value, so there's a tax percentage that you get, and it's put against the value of the energy property. So the value of the energy property is not necessarily, actually it's never the line item cost on your bid tab for the photovoltaic systems or for the geothermal system. You have to include all of the support infrastructure that goes into that. So you can allocate a portion of your design time into that. You can allocate a portion of your permitting costs into that. You can allocate a portion of the infrastructure costs that enable that energy property. So be cognizant of that you can really maximize the value of the credit on both sides of that multiplication problem, on the cost of property as well as the bonus percentages as well as the base credit amount. So with that, I know we've just got a few minutes left. Were there any other questions in the chat box, Alyssa, that you saw?
I am not able to see the chat since I'm sharing, so I
okay.
don't.
Let me check real quick.
Okay. Well, I do see the chat up here.
Well, I'm not seeing any in there.
Okay.
Alyssa, did you have any parting thoughts? Anything else you wanted to add?
Not necessarily. I mean, we did want to just kind of, I guess, highlight, a little bit about, Brayn just briefly. If you guys have any questions, want to schedule, times to talk with us in further detail, we'll be happy to. we do have a 3-phase process, which does include, a free phase 1 to really assess and look at eligibility for these various elements. If that makes sense, right, then we'll engage. That goes our second stage. Brain Power is really getting the calculation in order, and then our final stage, Brain Trust, is all about deliverable. That we have everything you need to support that calculation, and really we do limited hours of tax administration defend our work as well. So just a note about what's really setting us apart. And then of course we really structure on fixed fees. We don't do percentage of the credit amount contingency like some others. We do have folks with high level of expertise and subject matter relative and experience across the board. And then we focus on independency of service and don't do fee sharing with CPAs. We really rely on referrals and those sorts of things.
So Alyssa, who would they contact if they wanted to get started?
Yeah, absolutely. So we've got our contact information here, and we will be sending out the slide deck as well. So please do not hesitate to reach out to either one of us. I think we also have Jasmine on the phone as well, who is one of our account managers who really focuses on, working with CPAs in the Oregon area. So we can definitely have her send her contact information as well.
There she is. She can put her email in the chat. So
okay.
And on that, if anyone would like a specific presentation on any of these tax incentives, we're happy to provide a more detailed presentation and go into some more depth on any of these subjects.
Absolutely.
And this recording will be available on the AIA website on our program archives page, which I was going to do a link and forgot. So I got to do that real quick here. We do have a hard stop right at 1 because we have another event going on. But I wanted to thank you both for showing up and doing such a wonderful presentation for us. This type of thing is so important.
Great. Well, we appreciate, the invitation and really hope to, hear from a whole bunch of you. Thanks for your time today.
Have a great afternoon. Thanks, everyone.
Thank
you.
Bye, everyone.